this training video, we want to talk about the value of paying a tax on the seed versus the harvest. One of the things that has happened over the last 30 to 40 years is that we've been encouraged to put money into retirement accounts pre-tax, or in the case of an IRA, to put it in after tax, but then get a deduction. But 401ks have become the primary source of retirement for most people in this country, and as a result of that, we are deferring or postponing tax into the future. And there are pros and cons to the process, so what we want to help people understand is the difference between paying tax on the seed versus tax on the harvest. The seed being your contributions and the harvest being the retirement dollars that you take out. So let's take a look. What we have on the screen here is an account that someone is putting $6,000 a year into the account, and it's earning 6% interest. And over a 30-year period of time, from age, say, 35 to age 65, you will put in $180,000 into that account. Now, if it were going in pre-tax, then you would be saving the tax on that $180,000. So let's just take a look at $180,000 times 30% tax. That's $54,000 that you would pay or that you would save in taxes that you would normally have to pay if you hadn't put the money into the program. So let's compare that to what you will pay while you're in the distribution phase of the process. We have that $500,000 in an account that is still continuing to earn 6%. And upon retirement, you decide to pull out $30,000 a year, which would be about 6% of the account. So you're taking the interest out every single year. And you do that for a period of 30 years. You retire at 65 and you pass away at age 95 in our example. That means that you would have withdrawn from your account $900,000. So let's take a look at the tax on that. $900,000. Again, in a 30% tax bracket. And some people think they're going to be in a lower tax bracket when they retire, but we will address that subject in another video. But taxes more than likely are going to be higher for the vast majority of people, or higher than they think they're going to be. 30% of 900,000 should be 270,000. Let's just see if we can get it to do that. $270,000. Now remember, you saved $54,000 going in, but you paid $270,000 on the withdrawal phase. Oh, and there's one other thing, and that is if you were lucky enough to never have withdrawn any principal, if you were always able to get 6% and you only took $30,000 out, you would still have $500,000 in the account. And if it's in your 401k or an IRA, it has never been taxed. And so someone will have to pay the tax on that $500,000. It may not be you, it may be your spouse, or it may be your heirs as you pass it on to them. But the net result is there's another $150,000 or more in taxes due after the $270,000. So the reality is that you pay much more in taxes over your lifetime during the withdrawal than you save going in. And so what we suggest to people is that they take a look at that scenario and determine what might be the best for them. In most cases, we recommend that you use the tax laws applying to a Roth 401k or a Roth IRA. So you're moving the accounts from always being taxed to never being taxed.